Welcome to Chit Chat Stocks. Before we get to this episode, we want to talk about our friends at Public. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured, US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks, paid for by Public Investing. Full disclosures in the podcast description.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome into the Chit Chat Stocks podcast. My name is Brett Schaefer, and as always, joined by Ryan Henderson. Today, on our Wednesday episode, we are doing another super investor overview, and we are covering Michael Burry. Burry? I think it's Burry. Burry of Scion Asset Management and Big Short fame. We haven't decided the title yet, but something along the lines of the ultimate deep value investor, a traditional deep value investor, the art of deep value investing. We're going to be talking about his classical deep value investing style for buying stuff dirt cheap, regardless of business quality, how it worked for him. We're also going to discuss, but not the full episode, his housing bet short that became famous, trying to dissect that and how that was also perhaps a value investment, just in a different form. All right, before we get started, Ryan's going to introduce who Michael Burry is, how he became a well-known investor. I should say housekeeping items first. If you want our show notes, any written analysis, any coverage on Michael Burry, but in all honesty, it's more important when we do our stock research episodes, which will be coming out actually quite shortly here. Ryan's got a good one on Adobe upcoming. Just did one for myself on the Mexican airport operator OMAB. You should subscribe to our Substack, which gives you a free newsletter to go along with each episode. And if you enjoy these podcasts, give us a review, hopefully 5 stars on Apple Podcasts or Spotify. All right, Ryan, let's kick things off here. Any housekeeping items? And if not, who is Michael Burry, and how did he become such a well-known investor?
No housekeeping items from me, so let's dig right in. A little bit about Michael Burry's early life, because some people like to have a little bit of context around how these people got into investing, how they became so well-known, all that good stuff. So he was born in 1971, grew up in San Jose, California. If you've watched The Big Short, you may have noticed that he had Christian Bale in the movie had a cosmetic eye. In this case, that was factually correct. Michael Burry had lost his eye to a rare form of cancer when he was 2 years old. I don't think that really makes a huge difference in his investing career, but just a little bit of, I guess, background information there. And he was seemingly a very bright student from an early age. There isn't a whole lot about his childhood that I could find, but he attended UCLA, where he studied economics and pre-med, then earned an MD degree from the Vanderbilt School of Medicine, and he started a residency at the Stanford University Medical Center. However, he did not finish his residency because he ultimately ended up starting Scion Capital. So while he was a medical student and during his residency, he became enamored with the investment world. I can't remember where I heard this, but I believe the book that really caught his interest was Joel Greenblatt's You Can Be a Stock Market Genius. This was also around the time that the message boards and blogs were becoming very popular on the internet, and Burry was making a name for himself through those avenues. Now, most people that have heard the Michael Burry story know that he used to post on Value Investors Club. And that's a lot of people think that's how he initially was identified. I don't think that's totally true. So Burry had actually built a blog of his own. I believe it was called thevaluestocks.com, where that was really where he had made a name for himself. And his third year in his medical residency, he decided to drop out, start a hedge fund before he was inspired by Joel Greenblatt and Jack Byrne or anything like that. Like, he was committed to doing this on his own. He had developed a bit of a following on these message boards. People were following his blog. He was making a lot of money with his picks. And so initially, when he was starting Zion Capital, it was mostly going to be money from his family. However, right before he was planning to launch the fund, that's when he was approached by two different institutions that decided to back him. So one was Joel Greenblatt's Gotham Capital. And Joel Greenblatt, he was one of the founders of Value Investors Club, and Michael Burry had been doing a couple write-ups, I believe, on VIC at the time. Not as many people seem to follow Joel Greenblatt today, but at this time, the turn of the century, he was a bit of a legend. Gotham Capital had put up record returns, really good numbers for a decade. He had started Value Investors Club, just a really well-known guy and someone that is very reputable to be backed by. And then the second company was White Mountain Insurance, which was a company run by Jack Byrne. If that name sounds at all familiar to you, it's likely because Buffett has mentioned him a number of times at annual meetings and in various interviews. In fact, Warren once called him the Babe Ruth of insurance. He has really high praise for Jack Byrne, and apparently Jack Byrne has had quite an investment track record himself. So after getting some backing from both of them, getting some family money as well, Burry officially launched in November 1st of 2000. So for those that remember their .com history, that was basically there was kind of two peaks in the .com bubble. There was the initial peak, stocks collapsed a bunch, and then they rallied, and there was kind of the second peak that didn't hit quite as high, but that was basically the second rise. That second rise marked the start of Zion Capital, which ended up being pretty fortuitous timing, and I would say actually helped out Burry a ton. We're going to get to this in a second, but Burry was a true deep value investor, and he owned a lot of oddball type stocks, maybe what I'll call them. By owning those, he was able to get a giant lead on the indices within the first 12 months of launching his fund. I've got a chart here showing the NASDAQ from basically November 2000 to January of 2002. It dropped 50% in that time frame. So, and he was benchmarking himself more against the S&P, but really, if you don't own stuff that's correlated to the NASDAQ or the S&P, which is tough, probably more so today than it used to be. But if you don't own stuff that's correlated to the indices, and the indices drop 20, 25, 50%, it is a recipe for potentially good outperformance. In fact, that's exactly what happened. So we're going to get really into the strategy, the investments that shaped his, career. But in his 2001 letter, this was his 2001 annual letter. So he had, I think this was his fourth, maybe fifth letter that he had written to investors. He was doing them quarterly at the time. Zion Capital was up 68% gross performance since inception, while the S&P 500 was down 18.5%. So he crushed the market within the first 12 months. That's really where he started to gain his notoriety. We're going to get into kind of his process, what type of investor he was, and his 2006 housing bet, which really popularized him more than anything else. But let's start here, Brett. How do you think the timing of the fund helped, if at all, with his deep value strategy and also kind of his name and notoriety in the investment community?
I think it definitely helped. unlike, and this isn't taking away, he's obviously a very good investor. We're going to go through that, but this is what makes the likes of Buffett or maybe even Druckenmiller some of the best out there, the ones that are even in a higher tier, is that they can be flexible in different market environments. Because if we look at some of the investments that Burry has made today or even over the last decade or so, it that was not a time where deep value was as attractive. And yeah, I'm sure he has still done fine, but he seems to be very stringent in this strategy. He knows it works, and this was the 2000 to 2002 period was, from a factor perspective, I think one of the best times to be looking at small cap deep value in all of market history or of the last 100 years or so. So yeah, I think the timing helped. Um, Definitely helped.
Yeah. Let's get into him as an investor. We've alluded to it, small cap, oddball, deep value type stuff. How would you describe him as an investor, and what did his process look like?
Yeah, and before we get to that, maybe I should just give a quick table of contents for this episode. We're going to go through what his process is, how he invests, and then we're going to go through various case studies that we think can help identify even further how we invest. And then we're going to look at his portfolio today and what we learned studying his investor letters. Fortunately, we don't have full returns through today, although I think Scion Asset Management has been open, I think, this entire time since 2000 through till today. We don't really have the returns, but we're going to try to estimate how well he's done to the best of our abilities. But yeah, maybe we can read from this is a one pager for his first paragraph, and it kind of sums up how, well, in reality, simple his strategy is. Quote, "My strategy isn't very complex. I try to buy shares of unpopular companies when they look like roadkill and sell them when they've been polished up a bit. Management of my portfolio as a whole is just as important to me as stock picking, and if I can do both well, I'll know I'll be successful." So he's essentially looking for things that are absolute value, true deep value, stuff that might be trading at 0.3 times book value, 3 times cash flow, and all he needs in this almost cigar butt approach is a few years of good cash flow. The business isn't in as bad a shape as people are thinking. They're throwing the baby out with the bathwater. This is a dollar that's trading at 40 cents. I'll make some money on this, flip it, and then go do it again. And from reading Burry's letters and VIC write-ups, which I should say he posted on VIC, I think, until about 2005. So there's a lot of stuff on there. You can read his comments and things from existing picks. It's quite interesting. His handle is Michael99. But yeah, it looks like through and through and really focused, he is a classical deep value and contrarian investor. This is about the complete opposite of what we studied with David Gardner. I think that was the last investor we studied. And I think it's interesting to compare them back to back, because we look at Gardner, almost would never do what Burry is doing. Burry would never do what Gardner is doing, but both strategies can work if you focus on the right things. And Burry faded a lot of the popular ideas of his day. The vast majority of people were believers, and I guess still are today, that volatility is risk, and they're in that camp. And around the turn of the century, this was extremely popular. Burry took this idea, faded it, and used it to help him make a lot of money. Here's a quote from his early 2001 letter. "This performance was not without volatility. However, allow me to be quite stern on this subject. Volatility does not determine risk. I guide the fund to a net long position by investing in a concentrated manner and by frequently taking relatively illiquid positions in undervalued situations. The goal here is long-term capital appreciation with the emphasis on the long term." What's funny is each quarter he was just crushing the S&P. So there wasn't any concern about that, at least in the first few years. I know in the housing short there was some stuff around that and the timing, but Burry constantly talks about finding a dollar, quote unquote, a dollar, something that's worth that, in stock. If the stock's worth a dollar, that trades at a wildly differing price. And he wants to find it when it's at a discount. And if it's in a liquid stock, hey, that's great. If someone is dumping this for a reason that has nothing to do with the company's intrinsic value, fundamentals, that's even better because he can get on the other side of that trade. He doesn't care if it doesn't trade much. He doesn't care that it is in a foreign country. He simply wants to find the basic characteristics. Again, cheap price to book, 3 times cash flow, 2 times EBITDA, that will will lead him to find cheap stocks people don't want to buy. Now we have some other stuff here, but Ryan, maybe I'll let you interject. Any thoughts on his basic ideas? Seems very Ben Graham like.
Yeah, it was. And it was he you're not going to recognize a lot of the names that he invested in. Like if you go back and you read the write-ups and you hear, "Oh, he's this legendary investor." So if I go back 20 years, I bet I'm going to see some stock pitches that are, have turned out to be great businesses. That is not the case. Pretty
True.
much all of
Yeah.
them, I had never heard of the company name before studying him. Also, he looks for companies oftentimes where there's some form of indiscriminate selling. Like he's really kind of latched on to who's selling, what's causing the stock to trade the way it is. He really does care a bit about why something is priced cheaply, not just actually the price itself. And so you see a lot of that in his writing, and he tries to get to the when he says like I want to buy things that look like roadkill. It's a lot of things that people have discarded, and you actually even saw that. We're not going to talk about it today, but he was pretty agnostic to the type of company that he was invested in. He didn't care if it was, we're going to talk about a poultry producer today or even an internet play. At the sort of the, after the .com era had kind of bombed out a lot of companies, he ended up buying ValueClick, which was at the time discarded by a lot of people. Nobody wanted to touch internet companies. So he didn't care. He just wanted to know, basically, try to determine what it was worth. And as you can imagine, when all internet companies are selling off, there's probably some indiscriminate selling. People that wanted to polish up their books a bit, didn't want to be seen holding that. Ironically, I talked about all the companies being basically irrelevant today that he invested in, at least from the write-ups that we looked at. ValueClick, I believe, had ownership in DoubleClick, which ended up being like one of the most valuable enterprises in the world because it was the technology that Google bought, if I'm not mistaken, that like powered their
Yeah.
ads business.
Well, it became valuable because it was at Google. But
Yes.
yes.
But
Yeah.
that's about the only one you'll recognize. Anyway, it's just to say he'll look anywhere. I don't think there was any pocket of the market that he avoided. And he just wants to find things that look disgusting to everyone else and sell them when they look slightly better.
Yeah, and another key is not just that it traded at a PE of 3. It has to be a situation where he is comfortable that the balance sheet is not going to implode and that bankruptcy is not going to occur within the next few years. That is something you can find time and time again. He will look back and say, okay, they've consistently been profitable. The balance sheet isn't a total mess. And if they just remain, okay, maybe we're at the peak of a cycle here, but if they just remain profitable for the next few years, we're going to make a little bit of money. Now, I'm going to go through some of these quotes from his shareholder letters. They might be a little bit long. I don't know if I'll read all of them, but you can read the full quotes that I'll toss out in the newsletter. But I think they are important because it gives context to what's popular in the fund management industry and how he had to position himself. And he was kind of in a contrarian standpoint. So this is one from his shareholder letters. It's about a conference, an investment conference. And then it's also referring to this first gentleman here, a speaker that was very popular at a conference. I'm assuming another fund manager that has a lot more AUM than Burry. Quote, the very pleasant gentleman who spoke after me then proceeded to delineate how frequently his portfolio moved with a magnitude greater than 1% on a daily basis. I think the number was quite impressive for an institution that measures itself by such things, somewhere around 25 days in the past 2 years or so. And this, he proclaimed, minimized volatility and thus risk. He seemed a decent fellow, and if you wish me to provide his name and number, I would be happy to do so. He is quite sarcastic here too, Burry. Here's a quote that finishes: "Not that he necessarily needs the business. Perhaps it is not so surprising that your portfolio manager sat relatively alone at his lunch table, while the second fellow was quite popular. By and large, the wealthiest of the wealthy and their representatives have accepted that most managers are average, and the better ones are able to achieve average returns while exhibiting below average volatility. I'll finish up here. By this logic, however, a dollar selling for 50 cents one day, 60 cents the next day, and 40 cents the next somehow becomes worth less than a dollar selling for 50 cents all 3 days. I would argue that the ability to buy at 40 cents presents opportunity, not risk, and that the dollar is still worth a dollar." I think that sums up. We can just stop recording and go home. That sums up everything, right?
Just about. I mean, it's a good quote. And you can detect pretty sarcastic tones throughout his letters and even some of his stock write ups as well. Like, he never outright says it, but he's usually like, just paints a picture of the counterparty being illogical in some way. And this was a good example of that.
Yeah, and I'm not going to read this full quote for the next one here, but essentially, let me summarize the first part. He's talking about, and this is the post 9/11 investor letter that he wrote. He's talking about all this context with, the terrorism event and stuff like that, how it was a crazy time, the markets reopened, and there was a stock they were looking at. And when the markets reopened, it totally collapsed. And he had no idea why. And it had nothing to do with the terrorists. It wasn't exposed to that, even though what I thought was hilarious is he said, "We had a lot of exposure to hotels and airlines, and that really hurt our performance. But we're actually up for the quarter." So I always thought that was funny, where he would say stuff like that. He's like, "I just made this big mistake investing in an airline. Stupid me. But hey, the performance has been great." But he looked at this one, and this is a company that he didn't disclose what it was, but it was an
I
example.
actually,
Did
I'll
you find
stop
out
you
what it
there, Brett.
was?
I know what it was, and that's going to be my case study for
Ooh,
later in our discussion.
okay, good. That's a good find by you, Ryan. All right. Well, I'll tease it here, and I'll finish off the quote from the article. And this is an example of averaging down and how he was okay with that in some situations when the absolute value was so good. Quote: "The future performance of this position will have absolutely no correlation with either the performance of the general market or further terrorist attacks. At the quarter end, however, the position sat at a low point, trading at a valuation of just 3/4 the free cash flow of the trailing 12 months. And unlike many businesses that have faded rapidly during 2001, this business achieved record free cash flow yet again during the first half of 2001. I will note that the prospects for recovery in this position during the fourth quarter are wholly in question. However, over the next year or two, and especially over the next 5 years, there is a very high probability of substantial gains as a result of this investment. Such gains would be largely irrespective of the status of any economic recovery or lack thereof." Few takeaways from this, and Ryan's going to get into the specifics, which I'm excited about. First, Burry is trying to take advantage of indiscriminate selling, which became quite aggressive in this case. Second, he goes through that it has no relation to the terror events. So he's saying, okay, look, it's selling off for reasons, and there's just not a connection to reality here. And third, he highlights that it now trades at less than 1x annual free cash flow. And if things just go okay, it will be a home run. And that is exactly what happened. What's funny is in the fourth quarter, I'll have the full quote in the newsletter here. And what happens? The company gets acquired, and it goes up 7x just in Q4.
Yeah.
All right. Well, my takeaway is that investing in deep value stocks, there's going to be some losers. Not everything's going to work. But the winners you get, such as this one, can get you huge returns to make up for everything else. And you got a 7x return on this investment in just one quarter.
Yeah. And the other thing that I think is important to understand here is look, if you own Apple or Adobe today and there's some quote unquote indiscriminate selling, it's basically not noticeable. If you own
Yeah,
large
Buffett blew
cap,
out of Apple, and no one even noticed. Stock went
right.
up.
If you own liquid stuff like that, it's not really that noticeable. I mean, you see it sometimes when the lockup periods expire with companies that recently IPO'd and VCs or ownership start selling stakes, but even then, it's not always obvious. When you own something that's really small cap, illiquid, indiscriminate selling can have a huge toll on the actual stock price because you might have one or two funds or something like that that make up a huge chunk of the portfolio, and the bid ask spread is not as tight. So we've experienced this a bit with, and this is back in the day when they were pricing it in eighths of a share. It's not even like in the pennies that we have today. So sometimes they would have to, I assume, find sellers, or they'd go through a
Yeah.
broker and they would have to sell at prices that were significantly lower than what the market, quote unquote, market price was at the time. So when you get indiscriminate selling, especially in the cohort of stocks that Michael Burry was looking for, yeah, I would say volatility certainly is an opportunity as opposed to risk.
That is a good point. All right. This might be a little bit of a reiteration, but I wanted to include this because it is kind of funny that the term he used here becomes like a millennial and Gen Z slang term, and he's just a total nerd that I think maybe a Gen X or a boomer. But it highlights what he is looking for and how using the psychology of other people and the Mr. Market idea can help you make money. And he wants stocks that are out of favor and give people the quote unquote ick. Here's the full quote. Another issue I have with this sort of thinking is probably best summarized by the word ick. Ick investing means taking a special analytical interest in stocks that inspire a first reaction of ick. I tend to become interested in stocks that by their very names or circumstances inspire an unwillingness and an ick accompanied by a wrinkle of the nose on the part of most investors to delve any further. In all probability, such stocks will provide fertile ground for the rare, neglected, deep value situations that can provide significant returns with minimal risk and minimal correlation with the broad market. Occasionally, well known stocks fall into the ick category, and it is of those times that I become interested. So he's saying, like, in rare cases, like Ryan mentioned, the apples of the world, they'll fall in this category, but most of the time it's undiscovered, unloved names, stuff in places that people don't care about, countries maybe people don't like, as we're going to go through with my case study here. And I think what maybe a lesson for current day investors, you can get reactions to this instantly on Twitter, and it can be quite helpful.
Yeah, 100%. And it's nice to be able to have a sense of the sentiment pretty quickly on most things today. The other thing I wanted to mention here, and I think it was in the same letter where he talks about the ick part, he was not, he talks about how a lot of investors after 9/11 took the opportunity because there was a big sell off after 9/11. And I don't have it pulled up at the moment, but a lot of investors took the opportunity to upgrade, quote unquote, upgrade their portfolio. In there, he kind of like in passing mentions, I I have no problem investing in great businesses. I have a list of like, I think it was like 80 companies. I have a list of 80 companies that I deem to be high quality, large cap businesses. They're just not at my price point. So it was more not that he was like avoiding compounders necessarily, but he was just super, super strict in terms of price and his price valuation discipline. So,
It's
yeah,
interesting, yeah, because he would argue, I think, that he sees better risk reward in these deep value names. But I think the compounder camp, the David Gardner camp, a lot of other people out there that we know, it's a very popular strategy now, would argue that he's undervaluing a 10 to 20 year time horizon and how you can get a 100 bagger. But I you can make money both ways. As we looked at, David Gardner has had a fantastic track record and good returns. Michael Burry, as we're going to talk about later, not too shabby either. All right, listeners, we've got a new sponsor here at Chit Chat Stocks, and their name is Blue Chippers Club. Blue Chippers Club was recently started by two friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this community, everyone gets to share and break down their portfolios, pitch stocks, receive feedback, and participate in weekly calls. We truly love this idea, and it's why we're promoting it here on the show. In fact, we are in this community ourselves and enjoy just how much value we get by collaborating with other investors. If you're interested in joining, head on over to bluechippersclub.com and hit apply. Right now, it is completely free to join. The link is in the description.
Okay, let's look into some case studies, some investments he made. Now, like I said, these are probably not going to be very recognizable names unless you've been in the deep value investing world for the last 25 years. But the one I'm going to talk about today is Masaba Holdings. Brett alluded to the company earlier, but in August of 2001, so keep in mind that time, August 2001, a month before a very important incident in American history, Burry started buying Masaba Holdings. In his investment journal, I think this was the valuestocks.com, there's a place online that has these kind of archived, and you can go through some of his notes. He wrote, hoping for a Masaba takeoff. Buy 1,000 shares of Masaba Holdings at 880 limit. Good until canceled. He says Masaba is a regional airline that was recently dumped at the altar by Northwest, which is also a minority shareholder in Masaba. Masaba's primary business is to be an operator in the Northwest Airlink system. Masaba is the cheapest domestic airline. It gets paid by the capacity it makes available rather than the number of passengers it carries. It also has a favorable long-term fuel contract that buffers it from fuel cost fluctuations. Currently, one of its largest cost centers is the training of pilots. That will become less of an issue when Masaba opens its new domestic pilot training center inside of a year from now. This was a regional airline that he bought in August of 2001, and he actually made it his largest position in the fund. And a month later, 9/11 hit and crushed the stock. Something that I take away here is as you go through his journal, so he had a super analytical approach, very analytical focused. Like you really needed to know accounting deeply in order to implement this sort of a strategy. However, he understood the businesses to a really deep degree that he was investing in as well. So he goes on for a little bit about the regional airlines and the benefits versus being a sort of a major carrier. And in his Q3 letter, let me find the part that I want to talk about because I don't want to read the whole quote.
Well, I think this one I think I just read this one.
Yeah, I'll kind of just reiterate some parts of it. But basically, he had been buying and made this his largest position going into 9/11. And as you might be unsurprised by, the stock got destroyed after 9/11. People were worried that a lot of the world just US wasn't going to fly again for a long time. And it says at quarter end, however, the position sat at a low point, trading at a valuation of just 3/4 the free cash flow of the trailing 12 months. He does say something here that's important. He says, cash flow in the fourth quarter might be rough, which I don't think is much of a surprise considering that people did stop flying for a little bit after these incidents. In the Q4 letter, however, he also said something that was prescient. And I think maybe I'm overestimating how hard this would have been to do, but I think it took some pretty solid foresight to be able to say, fourth quarter is going to be rough. Not a lot of people are going to feel like flying this quarter, but in a year or two, everything's going to be back to normal. It was kind of like COVID. I think a lot of people dumped the airlines during COVID for the same thing. It basically played out as he said. But so let's fast forward a quarter. And Brett already alluded to this again, but I'm going to read the whole quote here. It says, the fund continued to purchase this security during the first days of October, whilst the security remained downtrodden. As it turns out, we did not have to wait 5 years or even a year or two. The stock tripled off its quarter-end lows by late October. Moreover, during early December, a competitor agreed to buy all of the stock of the company at a price that amounts to nearly 7 times its price as of September 30th, 2001. I find this bet really impressive. It is the largest company in your portfolio, the largest holding. 9/11 happens, and I mean, I think it would take some serious conviction in the business to double down during that period because the incidents that happened, but also having it be your largest holding. I think it would have been easy to get shaken out.
Yeah, I agree. doesn't come without risk. I did a quick Google search of Masaba buyouts, and it looks like they've filed bankruptcy multiple times since then. So he's not a compounder, buy and hold, never sell. But I think the way he was looking at it, and I'm curious if it was a price to free cash flow or an enterprise value to free cash flow, whether it was trading at such a discount there, because that can make a difference, I guess. But he was saying, look, things are going to be fine for at least the next year or so. We're going to have the cash coming in. Maybe he doesn't know exactly what management's going to do with that cash. But what turns out is other people saw that opportunity and said, hey, look, we think this thing is worth about 5, 6, 7 times what it's trading at, and we're going to buy them out, and that can work. Does it feel ironic, though, Ryan, that we've tried a similar investment and lost money so far?
Yeah, I was thinking about that a lot when I was actually reading through this. I was like, man, I'm just like Burry, except the returns are
Didn't work.
starkly different. The
Yeah. So
Yeah,
far, hey, it's not over yet, but didn't materialize within a 12-month period.
he also says somewhere in his letters, I think it's the same letter where he talks about Masaba Holdings being his largest position. He says, now, something along the lines of, now I know no one should be investing in airlines. And he even says, like, I'm not someone that's a major proponent of airlines because they were super competitive. But basically, this was too cheap to ignore.
Absolute value, yeah, and that can work. And that leads me to the second case study I have here, and it is Industrious Pachoco. I'm not going to try to pronounce that with a bad Spanish accent, but in October of 2002, Burry wrote up this company, which the ticker was IBA, and honestly, I had a hard time finding the ticker today. Don't know exactly what happened. I tried to do some digging, but it's not too relative to what happened to the story 20 years ago, almost 25 now. He wrote it up on Value Investors Club. His handle is Michael99, and you can still go find that there. And the write-up can be chalked up to, again, a very classic deep value camp. Essentially, he outlines that it's a leading producer in a fine but not great industry, and it trades at about 3 times earnings. First quote from the write-up: Industrious Pachoco is the $1 billion sales leading poultry producer in Mexico, where chicken is the number one meat. I think that's kind of a weird way to say that. I don't know why, just the way he described that is funny. IBA is a New York Stock Exchange listed ADR that is as cheap as ever. Pachoco is the giant in ultra fragmented industry. And he just lays out that at the time it's trading at PE of 3.2, EBITDA of 1.6, price to book value of 0.5, has good cash flow conversion, and a fine history of consistent positive profitability. And that's it. That was about the whole pitch. Does he care about the weird governance issues that they had that we don't need to get into today? No. Does he care that the sector is not that exciting and is a little bit cyclical? No. The stock is dirt cheap and is a reliable earner. And if things swing his way just a bit, they will become a home run investment. And like I mentioned, here in 2025, I can't find much on them, or at least on the stock, which might not be a good thing, but they still have a website and they say they have a stock listed. Honestly, I couldn't find it on FinChat. Seems like they're still a producer and they've been acquiring companies. They're still an operating business. But again, I found a thread that says back in 2002, after he wrote it up, after he bought it, the stock went up 260% in 5 years and had a 32% annual total return if we include dividends. So pretty good performance. I don't think the industry was that exciting. It's just the fact that he bought something at essentially a price that was saying it was going to go out of business within a few years, and it didn't.
Yeah, I'm trying to find any data on
No,
it,
it's
but
not there. Trust me.
it's tough. It says it has a 96.
No, the data's wrong.
Yeah.
Or maybe it's trading at an extreme discount now, but something happened. The IBA listed shares, that one's gone. I couldn't figure out what exactly they did, and to be honest, for this research, I didn't want to go translating Spanish stuff. So
Yeah, it's so. It was disappointing because I was going through all of his VIC write ups, and every single one I was like, let's see what the company turned out to be. And
nope, gone.
yeah,
Bankrupt.
it's so situational, and the holding periods are so short that it's hard to know how he was making money other than his firm's returns, which were doing extremely well.
Yeah, and that's the downside of this strategy is you have to recycle. Or not recycle. You have to find new ideas.
Yeah.
And what was I gonna say here? The fact that, and he put this in this write-up for Industrious Pachoco, the fact that it was hard to find information on the company, the fact that people were worried about that it was in Mexico and that it was an ADR, it's a foreign country, and the fact that they had these governance issues were keeping people away, that was when he said, I want to lean in here, and maybe there's an opportunity because everyone is just discarding this for no reason.
Okay, let's shift gears a bit to his 2006 bet to provide a little bit of context. He was performing really well for I think through sort of the first 18 months of the fund. He was constantly raising the amount of capital required to be a new investor in the firm. So I think by the
A
end,
lot of people probably adding money, yeah.
yeah, by 2001, it basically said like, unless you're investing $500,000, we're not accepting you, um, which is big for like sort of an emerging manager. But obviously by 2008, he was very well known. And that was because of one of his famous bets, which I got to say, way more complicated. Shout out to the movie for making it seem a little simpler because, man, it was a bit of a complex trade. Do you want to get into some of the details and I guess maybe the timeline on what all occurred here?
Yeah, we're going to talk about how, and you can find his letter outlining the bet online. We're going to talk about how he strangely simplifies every other investment he makes for his investors, but then in this one, he made it as detailed and as complicated as possible when he was writing it. I don't know what psychological game he was trying to play or prove, or maybe he was being is facetious the right word, or maybe he was mad at his investors given that, people have probably watched the movie and understood that there was a bit of conflict there. But yeah, let's dive into it. Burry's bet against the housing market and subprime mortgage bonds is now famous, and it's probably the reason why we are studying him today. It was popularized by the movie and the book of the same name, The Big Short, which I think Ryan and I have each watched 10 times. I think most listeners of this podcast will know the broad strokes of the bet. Burry believed lenders got too loose giving out home loans. He believed that foreclosures would soar starting in 2007, and he found a way to bet on this happening. But exactly how he did it is very complicated. So let's try to dive into some of the mechanics behind the bet, at least in simple enough terms for audio, and why this was such a hard trade to make and maintain. As a disclosure here, I am not an expert on fixed income, and I'm not an expert on derivatives, so if anyone with experience here in this subject, cut me some slack if something is wrong. I'm trying to simplify it without really any numbers. And I'd probably get something wrong if we went into more detail. So if we go back in history, kind of start the timeline in about 2004 to 2005, Burry was analyzing the mortgage-backed securities market. An MBS, or mortgage-backed security, is an investment vehicle that pools together a bunch of mortgage loans. So think, I have a loan on a house, a mortgage. Ryan has a loan on a house. 10,000 other people around the country have loans on a house. You pool them together, and it's a single investment vehicle. If you buy the MBS, you have the rights, or excuse me, maybe not buy, but if you invest in the MBS, you have the rights to the cash flow from these loans. Of course, the people who took out the mortgages need to have the cash to pay back these loans, or else you don't get the money, which is exactly what Burry wanted to bet against. You might remember this if, like us, you've watched this movie 10 times or read the book, but investment banks will take the MBS and divide them into tranches based on risk. These are then sold to investors. So again, a regular bank originates the loans, sell them to the investment bank makes the mortgage-backed security, divides into these tranches, and sells them to investors. Could be a pension, whoever. In general, you'll have the AAA rated MBS loans will have lower returns, but lower risk. No one's going to buy that at a huge discount, or there's going to be a lot of demand for those because seemingly there's lower risk for these things. And then the lower level loans with, say, someone with riskier credit history or groups of people with riskier credit history, they'll have higher risk, but potentially higher returns if they work out. Again, this is a simplification, But the key here is that when you divide them up in these tranches, the higher levels get paid first. So if there are foreclosures, defaults, if the cash flow isn't coming in, these riskier bottom levels start taking on water and then you get totally wiped out. And Burry rightly believed that these loans were, if you want to call them overvalued, misvalued, if they were not written correctly. There's the stuff about the rating agencies. It's still a debate to this day whose fault it truly was. But he saw that for whatever reason, they were overvalued due to the adjustable rate mortgages, loose lending standards occurring during the housing bubble. And he wanted to bet against these mortgage-backed securities because he saw them as wildly overvalued. And he thought it was almost certain that foreclosures were going to rise and they were going to default.
Yeah, if I can chime in here a little bit too. If you're thinking, well, why would a lender just write a bad loan? They are
Incentives.
not, yeah, they are not taking on the risk, right? Brett just mentioned it. They're selling it on to the investment banks who securitize it and invest. Eventually it gets put in the hands of some investor. So all they want, I assume it's some sort of a kickback or a fee for writing the loan. If you're a
Yeah.
loan originator, you just want people buying these homes. You want to be approving as much loans as you possibly can. And so what do? You give them teaser rates. And that was a lot of the, I guess, really bad loans was they'd have a low rate for, I think it's like the first 18 months or something like that. And then the rates would skyrocket. It would be unaffordable. But that wasn't the lender's problem. That wasn't the loan originator's problem. They were able to pass on the bag to someone else. So it was really a deferring of responsibility all the way up the chain. And yeah, there's probably a lot of different parties you could put the blame on.
Yeah. I think honestly, people try to put, I think, whatever camp you fall in, it kind of even gets political. I put the blame on everyone. For one, you should maybe understand your own financial situation and know whether you can afford a house or not and be able to understand what an adjustable rate mortgage is. It's not that difficult. Second, like, don't originate loans for people that can't pay them back. You should be honest about the credit underwriting, and then the bank should also be honest because you understand what's happening. But yeah, when Ryan mentions teaser rates, it's the same thing as adjustable rate mortgage. That's what was happening here. Those were the key part of it. And there were some other things. Just Burry he obtained extremely high conviction that these mortgage-backed securities were worthless.
FinChat.io is the complete stock research terminal for fundamental investors. They have robust financial data on more than 100,000 stocks globally. That includes more than 10 years of income statements, balance sheet, cash flow, and even company-specific segment and KPI data. Want to see Amazon's advertising revenue? FinChat tracks it. Like to track NVIDIA's data center business? They've got that too. The breadth of FinChat's segment and KPI data is truly one of a kind. You can go to finchat.io/chitchat to get 15% off any paid plans. If you sign up today, you will automatically get 2 weeks of FinChat Pro for free, no card required. Again, that's finchat.io/chitchat. The link will be in the show notes.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered, SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks, paid for by Public Investing. Full disclosures in the podcast description. And that they were going to default. And when he understood that, he wanted to bet against them. And remember when in that movie, I think it's Ryan Gosling, his character is yelling about the FICO scores that are below 550 when they're these AAA rated bonds. That's probably an exaggeration, but just think of how bad a 550 FICO score is. And these things are supposedly low risk securities. So let's get back to Burry. What did he do? He went to the banks, the investment banks, and had them create what is called a credit default swap for these bond-like instruments. A CDS, or credit default swap, is almost like insurance against an instrument. If the investment vehicle, in this case the mortgage-backed security, ends up defaulting or metaphorically catching on fire, like in the insurance aspect here, your insurance in the form of a CDS pays you back. Essentially, that's what happens. But unlike insurance, you don't actually have to be the owner of the underlying instrument. So it's almost like insuring someone else's car. It's a bit weird, but hey, it's finance. So Burry essentially used a CDS as a derivative to short the mortgage-backed security vehicles. Again, I might be using the wrong terms here, but essentially this is what happens. And he consistently paid his premiums on the insurance until they did. And the banks did this because essentially they're saying, let's use an analogy like a house. They're saying that we have this quote unquote single house that has low risk of, say it's not in a flood zone or fire zone or earthquake zone. It's extremely unlikely that this house or group of houses are going to have catastrophe insurance. And we're selling this guy catastrophe insurance with very high premiums. But Burry's looking at the other, on the other hand, and saying, no, I know that there's going to be a fire. So that's where the opportunity lied.
Yeah, and the other part that's kind of interesting here, and I'm not sure if you're about to touch on it, but the he once again had the foresight to not only just, first of all, there wasn't really a market for like betting against these things, so he had to basically like he had to create these deals with the banks, kind of handshake type agreements, and he wanted to make sure that they had solvency. And this is kind of one of the parts in the movie where he's like, I need to have some guarantees of solvency, or
That
like,
might be an exaggeration. I don't
no, he
probably
wrote
didn't
this.
actually say that, but
Well, he wrote in the, maybe he didn't say it to the banks, but he wrote it in his letters. Basically, I
yeah,
want to deal with the highest credit
right.
worthy banks because I'm worried that they're not going to be solvent, which is, kind of a crazy thing to say at the time. But yeah, I mean, incredible foresight that a lot of this would ultimately impact them in a huge way, and there is the risk that he might potentially not be paid back even if things go the way he wants.
Yeah, it is a bit convoluted because the same bank, theoretically, and I know there's a bunch of different banks interchanging here, the same bank that sold him the MBS, or excuse me, the CDS could be the actual owner of the mortgage-backed security, right? So it's essentially like the owner of a car selling you insurance on their car, and they're levered 20-1 against this car. So if they start seeing default rates on that, their balance sheet could implode. Yeah, so you can see why you could be worried here. And the interesting tidbit that, again, Ryan talked about this a bit, but I want to reiterate, is that the investment banks are the ones selling this thing, but they're the ones setting the price. So even though they were the ones on the other side of this trade, they were the ones that were telling him whether it was working or not. It wasn't a third-party broker. They were pricing it, and this is what caused a lot of drama in the story. But once the mortgage-backed securities started defaulting and going down in value, people wanted to pay a higher price for credit default swaps for this insurance on these loans, which is how Burry made a fortune. If you know the famous scene where he calls the broker, again, it's exaggerated, it's dramatized for video for the movie, but essentially these went up in value. The CDS went up in value because people wanted insurance on these products because the risk that they were going under was getting realized. And then that's when he made a quick profit. Well, maybe not a quick profit, but that's when the value of these started going up a ton in 2007, 2008 period. I'll close out here before we kind of go into our discussion questions and his portfolio today with a quote from a blog. Let me put the name of this person here. I honestly think this might have been like a grad school write-up or something, but his name is Paolo Parboni. The blog is, what is it called? FSG Journal. I'm going to link to it in the Substack, but it helped me understand this quite a bit and simplify it. Here's the quote. Burry was competing against the clock. If the credit event didn't take place soon enough, he would run out of money due to the premiums. Eventually, homeowners became unable to meet their mortgage payments, meaning that their MBS would no longer provide cash flows to investors. This was the credit event that made the swaps that Burry held a lot more valuable. The swaps provided protection against mortgage defaults, so demand for them increased when people stopped paying their loans. This means they could either be sold to MBS owners who would need the settlement payments or be held to receive the claim, as in the insurance payout. So Burry and a lot of these people if you look in the movie again, the movie is dramatized, so I'm not sure exactly how accurate it is, but the Steve Carell character kept holding on to it, right? But there was the risk that the banks were actually going to go under. So Burry, he sold it back to the banks because they wanted that insurance. But they paid him
Yeah.
back it's almost like shorting and saying, hey, look, this thing is worthless now. I want to make about 10x on this.
And all along, investors are worried about what he's doing in Scion Capital. They're like, I thought you were just a stock investor. I thought you were,
It's a big
finding
pivot.
finding undiscovered gems that, could polish up a bit, or not gems, but undiscovered roadkill that could be polished up a bit. And so you're making this huge shift. Like, why are you the one that's going to know that the entire housing market's going to collapse? And why are you making this super complicated bet? And that's when he writes this letter in 2006 to all his investors, which, if you want to feel discouraged as an investor, I encourage you to go read that, because that is
He
one of the most,
definitely overcomplicates it unnecessarily. I don't know
probably
why, though. Why do you think he does?
out of spite.
Yeah, maybe they're freaking out on him.
Yeah, I think people would probably kind of treating it like, you don't really know what you're doing here. And
Yeah.
he goes into just extreme depth on the bet that he's making. And there's also this kind of famous scene where the guy that's meant to be Joel Greenblatt is like, give me my money back. The other part that's important to mention is Joel Greenblatt's getting calls from investors. I want my money back. So he has these institutions that are invested in his fund, and those institutions are getting withdrawals. They need money. So they're going to Burry saying, I want my money back. And Burry has to keep it in there, or else the bet's not going to pay off. And he's done all this work, and
Right.
he's been totally right. And ultimately it does pay off. There's all these questions. He's like, all right, frequently asked questions at the end of this 2006 letter. And it's like,
Yeah. How
what
they're
if
going to
you're
screw us.
wrong?
Yeah.
What if the banks screw you? All this stuff. And he's like, this just seems like an improbability, all this stuff. And he was dead right. I mean, he was totally right on it. And I guess this kind of leads to the next part that we should talk about. But his returns are not public today. He wrote on the board after, and I don't know if this is like factually correct or what, but he wrote plus 489% Scion value. If we assume that that was his total return after the housing bet since inception in Scion, gross, net, whatever.
Sounds reasonable, I'd say, given his returns up to 2002 and then the housing bet profits.
Yeah, I would think so too. He was up 489% over 8 years. That same time period, the S&P 500 was up basically flat. So he crushed the market during this time period. And now I know a lot of people say, what's he done lately? What's he gotten right? Truth is, we don't know. We don't know what the returns look like. But the total returns from the S&P 500 from when Michael Burry started his fund in November of 2000 to today, and we're recording this on Thursday, February 6th, 2025, have been up, I think, around 590%. So if we assume that Scion Value, the Scion Capital Fund, was flat for the last nearly 20 years, which seems very unlikely, he's still almost beaten the S&P. So now,
Returns likely strong,
yeah,
I think, is the summation.
he likely outperformed the market over the last 25 years, would be my suspicion.
Here's my other discussion question. Yes, that's good data for the listeners. Would you have freaked out, you think, as a Scion investor?
Yeah, for sure. Especially after I read the letter that he wrote, where I'm like, it made me even more confused and just put my brain in a pretzel. Honestly, if I didn't have the ability to watch The Big Short, I would have been so lost at this point in time.
And yeah, it's much easier to say you'd have confidence in hindsight. I think maybe where he got discouraged is the fact that this wasn't his first year running the fund. He has a decently long track record, and he got absolutely zero trust from these people. And maybe the story changes it. I know sometimes Michael Lewis has been known to exaggerate things now, given kind of what's been exposed with his stories. But I would hopefully just have a lot of questions and not try to freak out, because I would maybe want to understand what's going on. you know, but
Maybe.
it could have gone down that way and not have been as confrontational. I guess we don't really know, but I think what's interesting is he almost saw it. And when you look at the context today, obviously it worked out, right? And, it wasn't guaranteed to work out, but he almost saw the defaults and the cash that was not going to come in, and the fact that these CDS ones were deep value. Like he saw that as almost the same as what was it called? Mariba Holdings, Masaba Holdings. I think he saw those very similarly, where he goes, "There's a low likelihood we don't win."
Yeah, I think you're right.
Because when you
But
understand the actual credit um, underwriting that was going on here, it
but it's
was pretty much guaranteed that these things go bust.
but it's much harder to articulate to investors. And I think
Yeah,
this
it's true.
was my suspicion because Michael Burry's kind of gotten back into this like scene or investment realm. I guess he started a Twitter account like a couple of years
Yeah,
back.
you know that the meme of saying like that person and then something random that they're known for with that one guy on that podcast. It's like Michael Burry, the Fox News tweeter.
Yeah.
Yeah,
Yeah. He, I would imagine this was a very formative event in his life. And I wouldn't be surprised if he got a little resentful after this and losing trust from a lot of investors. And I've
and the banking
heard,
system.
yeah, and the banking system. And I have heard that Scion values mostly all his money at this point. So he's basically running the fund as just his own personal holdings, no outside investors, which
Done
if I
quite
went through
well.
this experience, I would want just my own money probably too. Don't want to have to deal
Yeah,
with the communications.
we ran a fund with fantastic investors that never ever pestered us, and we're grateful for that. And even with that, it can be a pain. And I just would think like if you had bad investors, it would just be such a pain, and it's so much easier just to invest for yourself.
Okay, let's talk about his current holdings. Now, typically this is the point in the show where we can go around and talk about, all the different stocks and whether they're promising, but his turnover is so quick with a lot of positions, and he also has options exposure, I think, as sort of maybe some sort of embedded hedge. Not really sure.
International guy too. He's not afraid to go international. I wouldn't be
Yeah.
surprised if he was a Korea and Japan guy right now,
Yes.
honestly.
So his 13Fs mean very little, but from what we do see, he has a large Alibaba stake
He's a
and a
Baba
large
boy. Yeah,
JD.com stake. So he's investing in China, which I guess if you believe that the cash can be returned to you on face multiples, there is some deep value there.
sure.
But
Oh,
these are also the only holdings we see. Like,
that's true. It might be a smaller position. Yeah. And he does have it hedged, which is strange. And again, it's just very difficult. One that I think is a little bit interesting, Shift 4.
yes, he owns Shift 4 Payments. The thing is, this whole thing his could be like a fraction of his actual wealth. So it's hard to know like whether or not this is just like a flyer or what he's doing with it. So
And he could have sold these already because it's what? We're recording this on February 6th. 13Fs come out February 15th, right?
I'm not sure.
And I think it's something around that. So then these holdings are from October, giving his propensity to trade. I mean, if we look at Shift 4, it's probably done quite well for him. I wouldn't be surprised if he sold.
All right. What are our takeaways from studying Michael Burry? Lessons, if we have any.
Yeah, I see you wrote down some here. I was trying to go my conclusions from the episode. I think first is do not be afraid to invest even if 90% of people tell you you're dumb. Or that's not you're dumb, that the idea is dumb. In fact, that should maybe indicate it's a good opportunity. You should come to your conclusions on your own. And if you think value is there, the reason value is there is because a lot of people don't see it. And I think you
I
saw
like
that
that.
time and time again throughout this episode, throughout his investments. And second, margin of safety can be high if you buy something at 2 times cash flow and 1.5 times book value.
Yeah. Yeah, I like that lesson of like do your own research, trust your own. If you've done your own research and come to a certain conclusion and you're quite confident in that conclusion, trust it.
Yeah,
Don't
trusting's harder.
don't be shaken out by someone who hasn't done as much research and writes it off. And because if everyone's writing it off and they don't know it very well, that is probably an opportunity. That means they've gotten the ick by it, and
Yeah.
it's the potential for returns for you. My takeaways. So I already mentioned this, but one interesting thing you figure out studying his investments is that very rarely do you recognize the name of the company that he was actually investing in. And if you are able to find a stock chart, they typically don't look great over a long time frame. However, for the few companies where I was able to find a chart, the stocks typically performed pretty well immediately after his purchase or around the time of his purchase, and it didn't last very long. I guess my takeaway here is that that means he followed his ethos. These were not great businesses. They weren't long-term investments, but they were so cheap the market couldn't ignore them, and he would typically get some multiple expansion. But the two lessons were, and this is not something I'm really internalizing. Like this might not be something that I apply to my own life, but following him, it was buy it, don't marry it. Burry never really seemed to get overly attached to individual companies. As new information or new investor sentiment, new valuations presented themselves, he would move on. The second one, I think to be a true deep value investor, you have to be quite active. You can't just be buy and hold, because for him, he was not only buying the roadkill, but he was selling it once it was polished up. So you had to get the selling right. I don't know if I necessarily love that for myself, nor do I think I can do it very well. But if you are a deep value investor and this is the strategy you want to implement, you got to have an idea of what it's, you have to have a really solid idea of what it's worth, and not just that it's worth more in the future. Have an idea of this is where it's too cheap and this is where it's too expensive. And I'd rather have other opportunities than that, because you got to get the buying and the selling right.
Yeah, exactly. That's the downside of the strategy, the tax implications, and the fact that you have to consistently come up with new ideas. But I think a general takeaway for listeners is you don't have to invest like Burry. I know a ton of people out there, and maybe that's just the circles we run in, that just despise this type of investing. That could be the sign of the market bubble. But I wouldn't I wouldn't say I can never invest like David Gardner, and I wouldn't say I can never invest like Michael Burry. I think you should try to build that tool set and learn, like we're trying to do here, from both of them, because there might be some times where this deep value strategy looks attractive. You look at some stuff that might not be that great. Okay, it's not the best business, but it seems pretty good. It's trading at 5 times earnings. Or this is not a good business at all, but it's trading at it's trading at 1 times cash flow,
Yeah.
as Burry highlighted with that one write up. When the absolute value is there, sometimes there can be that opportunity. But I wouldn't just shy away from it just because you are a little uncomfortable with it, or that's not the style you were brought up in.
Yeah, I like that takeaway. Try to get, if I had one thing to pull away and kind of implement into my own tool set as an investor, try to get a gauge on what people think of the business. The worse the sentiment, the more you should keep digging, would be my kind of takeaway here.
All right. That's a good way to end it. Thank you to our sponsors for this episode, public.com, FinChat. Go check them out. Use our link, Blue Chippers Club, all good stuff. Speaking about Modern Valley Investors Club, Blue Chippers can help with that as well. All right. Let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you everyone for tuning in, and we'll see you next time.